I'm Ted Seides, and this is Capital Allocators. This show is an open exploration of the people and process behind capital allocation. Through conversations with leaders in the money game, we learn how these holders of the keys to the kingdom allocate their time and their capital. You can join our mailing list and access premium content at capitalallocators.com.
All opinions expressed by Ted and podcast guests are solely their own opinions and do not reflect the opinion of Capital Allocators or their firms. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of Capital Allocators or podcast guests may maintain positions in securities discussed on this podcast.
Today's show is the second in an ongoing mini-series discussing training grounds, organizations that have developed industry leaders. The first episode discussed Carnegie Corporation, where over a dozen years, 8 of the 17 investment professionals that came through the doors became CIOs at Carnegie or other institutions. Bain Capital is one of the world's largest private alternative investment firms. The firm was founded 40 years ago with a half a dozen team members managing a $37 million growth equity fund and has expanded to nearly 2,000 people, 180 partners, and $200 billion in assets under management today. During that time, Bain Capital has developed leaders across every category of alternative investing, many of whom started in the firm's private equity business. My guest to discuss this training ground is John Connaughton, the co-managing partner and global head of Bain Capital Private Equity. Our conversation covers Bain Capital's founding idea, recruiting and training, governance model, inflection points of growth, compensation, case for staying private, culture, developing leaders, and succession. Before we get going, Capital Allocators has entered the world of AI. We've trained a large language model on all our transcripts to help you learn anything you want from 7 years of conversations. We've affectionately called this model ChatGPT. It's safe to say Hank Morgan and I have no idea how to build an LLM, train data, and get the outputs that ChatGPT delivers. So a special thanks goes to our friends on the data science team at Atalaya Capital, who took on the development of the minimum viable product from start to finish. What they've done for us barely scratches the surface on how they're using AI to enhance their investment process, but I'll leave that to you to discuss with them. ChatGPT is the latest add-on to our premium membership. To sign up for a premium membership and access ChatGPT to query all our transcripts, go to capitalallocators.com. Thanks so much for spreading the word about ChatGPT. Please enjoy my conversation with John Connaughton about the training ground of Bain Capital. JC, great to see you.
Great to see you as well.
Well, it's been 40 years Bain Capital, and I'd love to have you take me back from the very beginning, the initial thought of launching the business.
To take you back, you have to go back to 1973 because Bain and Company was started on a very different premise as a consulting firm versus McKinsey and BCG and Booz Allen. Effectively, those firms were talking about big ideas they sold to multiple clients in one industry. Whereas Bain wanted to do one client in one industry, and then we're going to partner with them over a long period of time. That was a great business. They looked at their metric for success as to what was the equity value of the clients that they advised. And so the light bulb went off in 84. If we're doing this for clients, why not put our money where our mouth is and make investments?
Who was it that came around the table and decided, let's turn this into private equity?
It was ironic that when it was started, we were advising Fortune 100 companies, but once we got into it, nobody was going to give us capital. We didn't have LPs that were institutional. We didn't know anybody on Wall Street. We actually started out in venture capital and growth equity because you could just write checks, didn't rely on other people's checks. And the money we raised was from the partners at Bain and the principals that started the firm and foundations and family offices, not big institutions. We started that journey on the idea that we could help those businesses, but they were small businesses. And so the resources to go into all these little companies was not as enticing as something where you could get into buyouts. Larger companies really think about operating and strategic issues from a higher altitude. And I think that's the evolution that we saw that made this really interesting for us. It was a little bit going back to the origin of what we did at Bain, which is let's advise big clients and do buyouts and actually transform strategically and operationally. It was very uniquely not people from Wall Street. Mitt Romney, who was one of the most successful consultants at Bain, he wanted to find a path, a lane for himself. He was very talented and was terrific with relationships with management teams. Smartest guy out there. But he wanted his own lane. So he, plus a bunch of former consultants, said, let's do this. And that was very odd because in the industry at that time, it was all transactional. People that knew deals, people that knew Wall Street, people that knew the banks. Those set of people, they were just talking about strategy and operations. Whereas if you went into any other firm, people were talking about how are we going to do this deal? How are we going to finance this deal? How are we going to get out of this deal? And it was a very different narrative inside the halls.
What was the trajectory from the beginnings as venture growth into what became more buyouts?
The benefit of buying low and repositioning a business and selling at a higher multiple, the benefit of taking something that's losing some money and making a lot of money and then multiplying that times that multiple with little leverage, it's a pretty attractive model. I think we bought AccuRide. I think it was levered 85-15 or 90-10 and had $5 million of investment and we made 25 times our money. And that's because we turned the business around, not because it was just financial engineering. We actually took a business that was struggling and we made it a lot more profitable. Just the benefit of having control. First of all, you don't have control in growth equity and venture often. So being able to pull the levers that you want to pull to make the business more successful, combined with the ability to really drive the exit and drive the change, was pretty attractive.
These days, you don't think much about 25 times multiples in a business that isn't some technology venture massive success. How long did it last where this combination of some financial leverage and operational turnaround really produced just extraordinary returns?
There's two elements of returns. There's both the absolute dollar deployed plus then the multiple on that dollar. I think that at that time, $5 million going to $125 million is pretty attractive. But I think over time, our ability to deploy $30 million and make 8 times was twice as profitable. The evolution of scale during the 90s, after the crisis of the savings and loan, where rates went up to 14 and 15%, and people started to be a little bit more conservative on the debt side. I think that evolution resulted in us all going to larger deals and deploying capital. And then our resources deployed against larger companies because we put half our people are often in the companies on a day-to-day basis. And so having the ability to actually get that return on our people's time for scale opportunities, that really drove all the business to look at larger deals over time.
When you started with a group of principals that had been consultants and then you start to scale the business, how did you think about recruiting talent and training the people in the way that would be productive for the business?
We're in the investment business. Investors have to take risk. Investors, hopefully, over time, will be judged to be really good by virtue of those returns they achieve. We hire from consultants who are risk averse. They probably went into consulting because they didn't want to take the kinds of risk that one would take in an investment business. And the rest of the industry was hiring from investment banks, which I think are principled at one level, but at the same time, they're really about getting fees for transactions, not for making returns on investments. So it's probably the worst possible place to hire from. And we hire 75% from consulting firms and 25% from investment banks. But what we found is we had a unique advantage in recruiting talent because they are the very people who wanted to leave consulting because they were frustrated about just giving advice or not being able to see the impact of their advice being implemented and yielding a terrific outcome. And so there was a great allure from anybody who in consulting who self-identified as somebody that wanted to take this to the next level. Nobody in the industry was going after consultants with that framework. They were all going after the banks. So we had a huge competitive advantage in finding those people and then ultimately developing those people to see if they could transcend, I think, just the advice business to getting into the risk return business.
How do you think about developing the people once you brought them in?
We'll get them early. Honestly, we were the first ones to really start recruiting right out of college or certainly right after a couple of years. in their first job. And I think getting people in early to really get the mentorship and training from people more experienced over a long career. I've been here for 35 years. I think there are those that are in the senior team who have been here for 25 or 20. The original founders, same thing. So it takes a long time in this business to develop expertise and relationships, especially in our model, which is so team-oriented. That training is going to take a long time, and we committed heavily to it. We also had the benefit of Bain Company, and the consulting culture was a training and development culture, which is very different than a lot of the Wall Street orientated firms.
How did you structure your research deal teams to allow those people to learn the skills they needed to over time?
Well, a couple of things. One is we were a team-based structure. I think the nature of what we were looking to do was to create underwriting with our own insights. We didn't rely on a lot of outside parties. And so the ability as a junior person to really be close to the work that you were doing, that were going to create the insights that was the underlying investment hypothesis, that was pretty different than the industry, which really had a deal quarterback and a deal processing engine. And then they outsourced all their diligence, and they didn't have their own proprietary captive diligence. So if you're a junior person on that team, you're incredibly important to that team. You have to have a voice. Your voice and your insight is part of the reason we're going to do the deal. Your advocacy is really critical. And then you have a senior team who is more experienced with judgment over time and pattern recognition and relationships. And so that ecosystem of having a lot of people close to the work who have collaboration with the senior team and then coming up with an investment decision, that's a pretty unique model. And on top of that, we always had 2 deal partners. And more recently, we also have a portfolio partner on every transaction. And so that ability to be working with each other, being a devil's advocate, creating a team-based real discussion about, do we want to do this deal? I think that's a very different than the industry, which is very individual-based. A single person having a point of view, living and dying by their own individual point of view, as opposed to a collective team effort.
As you began to enter that phase where you, alongside the industry, were starting to scale, how did you start to address the business implications of that?
The first thing that was important is to keep all our people. I think what you saw a lot in our industry evolution, and certainly even today, is people get to a point, they're not one of the founders, they're successful because they've had a couple transactions, and then they spin out and form another firm. And so I think I give the original founders and Mitt a lot of credit, because the founder-oriented models, generally the ones that didn't survive more than a generation. For us, it was like, how are we going to keep the talent that we have and give them a lane and give them the opportunity? And it starts with being flatter, not having such a disproportionate amount of economics go to a single person, but actually distributing it. And then showing a commitment. That's going to be the approach towards partner development, partner equity, the way the partner works in terms of decision making. And I think this notion of partnership was a very different choice than the founder models that started.
Was there a certain moment in time where that conversation took place that changed the composition of what would happen going forward?
It certainly happened from the beginning when Mitt assembled his team, in the sense of who he brought on and how he treated them and what their goals were. But there's moments that were tested all along the way as to which direction we would go. There was a time with my peers, we were all very aggressive and probably self-aggrandizing in our own way about our own capabilities. And we said, look, we want to be able to be your equal partners. And these were people 10 to 15 years older than us. And there was a real commitment that that was going to be the approach that they would take. Now, we had to push a bit to get that, and new lanes were created. A lot of my peers went on to start our venture business, start our Europe business, start our credit business, start our public equity business. And so the notion of creating room for the size of the pie to grow and retain that talent, that was a big choice. Mitt left in 1999, and Mitt was very good at keeping all of this great talent. But the question was, okay, what's going to survive after Mitt left to go to run the Olympics? The group got together and really reaffirmed that we want to be a partnership. And I think that was a big moment in time. And then, of course, when everybody started going public, we saw the founder monetization models that allowed for a small group of people to create enormous wealth through catalyzing a sale to reward that founder. I think that was also a moment in time. But each of these, we've reaffirmed the idea that we really want to have this breadth of partnership, which we think will yield to a better model.
So take me back inside the room to some of those conversations. The first one is Mitt leaving. So he's going to go off, run the Olympics. The rest of the partners need to get together and figure out how you're going to move forward. And yeah, there's a reaffirmation of this is going to be equal. But how did that really come to fruition? And what were some of the frictions in those conversations that got resolved?
We've learned over time as we've gotten larger, the rigor around how you govern and operate is really important as you scale. We wanted to create a form of governance that allowed for the broad number of partners that remained to elect the group that could lead, but they would be accountable to the broad partnership for that leadership. And that structure, I think, worked pretty well because it both had a democracy, but it also had a centrality to a few number that could actually be the stewards of the partnership model. And I think that's what we decided would be the governance going forward, as opposed to just a few people who would then take control and the ownership. And then you'd find that there would be a ton of people leaving when you did that. So that's an important dialogue. I think there was also the fact that there were a lot of people of my generation who really aspired for that model. And so they didn't want to lose that group. I was only 1 year into the partnership when Mitt left. So the stakes were high.
What did you come up with in terms of the roles and responsibilities of that governance model at the time?
There's the need to have compensation and rewards committees. I think there was a need to think about how we entered into new businesses and how we created the appointment for leaders. And so we had different committees that were ultimately responsible for those two major activities. And I think those were all representative, but also elected by the underlying partnership at that time. Now, remember, the partnership at that time was only 20 partners, but that's a lot more when I started, which was 5.
So you take that forward as you've continued to scale and grow in some of those new initiatives. Walk me through what's happened with the scale and scope of Bain Capital.
Sure. I think one of the things that perhaps gets lost a little bit in the noise of today's multi-strats is that when we originally started, we were one of the first that got into credit and public equity and venture, one of the first to really expand globally with our own people, putting feet on the street, with building big local teams. We had this vision that we were going to monetize into a public equity market. We just did it partly because we really wanted to have the expertise in some of those areas like credit, like understanding public equity markets, like understanding disruptive technology and venture. But we also wanted to find ways to provide opportunity for our people. My peers at that time really wanted lanes that they could deliver their own careers through. And so these folks were empowered to go build these businesses. Some of them actually came back to the firm who had left the firm because we didn't have some of these lanes. But when they did, they were really attractive partners to develop these new lanes because they knew how to collaborate, because they had the relationships, they had the same training, the DNA. So when we're collaborating across geographies or these new businesses today, it really works a lot better than the franchise model of a lot of the multi-strats.
How did you think over the years about either promoting or putting someone into a role to go run a new business compared to either hiring or bringing in a team to run a new business?
We like to say we don't like to feel like we're the stereotypes of our industry, and we have a different set of core utility functions that make us successful. One of them is a desire to collaborate with the platform. And as a result of doing that, you become really a lot more successful than you could do on your own. Most people, when they look at a platform, look at it the other way around if they're coming in laterally. They think of that platform as a great place for me to individually exploit my incredible capabilities with the Bain Capital brand. And when people do that, they don't collaborate. They're just looking to leverage the brand to effectively become more successful individually. The number of people that got turned over in the international expansions of a lot of the multi-strats in Europe and Asia has been amazing. We've had the same country managers in Japan, in China, in India, Korea, and Australia from the very beginning. And we've been there for 20 plus years. Whereas I think our industry has just found they bring laterals in and they want to be part of the platform. And if they're successful, they spin out again. And if they fail, it's because they're not that successful as investors.
When you brought in laterals, when did it work?
It's really a tremendous success in our international geographies. And over time, it's been a tremendous success in some of our new businesses. And I think selectively in some of our verticals where we've had the need to bring in that kind of vertical talent. But the common thread for all of those is that the minute that person got there, they understood how they could get impact from this platform. Yuji Sugimoto runs Japan. We have a tremendous franchise in Japan. Yuji understood that he could partner with all of our industry verticals in the US to have that much more expertise to talk with management teams in Japan, to do scale deals by not only having an Asia fund, but having a US fund that could collaborate with the Asia funds. Most of the folks that have been successful, they immediately get here and then they look around at the firm to figure out where they can get collaboration and support to fill in where they couldn't otherwise do that on their own. And so it is that ability to reach out and then the reciprocation of that from our partnership.
So you've had these leaders for a long time in a bunch of these geographic and asset class verticals. How have you thought about the training and development of the pipeline of talent below them? And maybe even starting from when people are first coming into the firm?
It's amazing the amount of global training and development that we do across the platform. We have cohorts all the way from entry level orientation and training all the way up to mid-level to principals, even partners, where we bring in that talent. And we do a lot of training and development that is actually across the platform. There'll be some dedicated training and development that's associated with just single businesses or geographies, but we do a lot of global training. And I think that develops a foundation for the common values, but also the common skills and the common teamwork orientation that we bring to deals. But at the end of the day, it's really about those one-on-one relationships with somebody who's been here a long time, who is willing to invest in the success of the people that are on their team. We have this saying, who are the 10 people that are going to be your mentees over the course of the career that you have? Or you're going to look back and say, those are the 10 people who were incredibly successful 10 years after me. And so when I look at the people that mentored me, I'm incredibly grateful. And today I'm very excited about that group of folks underneath me who have been, frankly, at the firm now for 20 plus years, but they will be the future of Bain Capital 10 years from now.
When you have such scale and scope, inevitably you run into challenges with how to motivate people with the lens of their compensation. How have you gone about thinking through compensation across the whole firm?
Look, I think part of the trick in our business is you can find ways to address people's success by giving them a lot of variable economics. And we've seen a lot of firms do that where they eat what you kill. But that doesn't work in our culture. Our culture is a little bit about the long-term arc of impact and track record that you have, but also, frankly, how you've been able to collaborate and work with the rest of the firm. And so that puts a lot of pressure on a reward system that has more nuance to it than just purely eat what you kill. But we do a lot of work to really evaluate people on all of those metrics. And then we try to reset people's compensation so that they are rewarded and aligned to that long-term track record. And so for our firm, we don't have a lot of, we're going to change your comp every year. It's really that set of performance characteristics of carry. And we align with everybody's co-investment. People are huge co-investors at the firm. So they have investments in each other's businesses. But frankly, where we could drive the most benefit is just, if I help out another geography or another vertical, they will come back and help me out. So it's just the embedded value of that interaction that creates that, I think, that glue that creates the outcomes that reward people for individually collaborating with each other. Now, we've had to do other things over time. Certainly, the industry has public currency, which serves a different master. What we've tried to do is really accelerate our own principal orientation even further. We've always been at the head of the pack in terms of how much money we put in our own deals. And every one of the partners does that. And every one of the employees does that, is they're investing in their deals. But we've actually enhanced that by putting a balance sheet together so that we're investing behind all of our businesses. And as a partner, you get to participate in all of the upside from our investments. And that's actually aligned with our LPs as opposed to something that's in conflict if you have a public security.
What are the mechanisms of how that works?
We raise a balance sheet, which is long-term capital. It's very low cost. We generate a return that is substantially ahead of that. So think about low rates of 19, 20, and 21, where we raised the capital, and then think about our average returns being 20 to 25%. And so if we invest that balance sheet, as we expect to over the next 10 years, the compounded benefit of that accumulation goes back to the partnership. So it's a very aligning set of rewards associated with just the fact that we're principal investors and produce these terrific performance outcomes.
So inevitably in a firm of your scale, you're going to have a natural churn of some of the people on the team at all levels. What have you learned over the years of the folks that leave?
Look, we've all been through the cycles of the dot-com and the hedge funds, and then more recently, the growth equity funds, 19 to 21, where, the ability to get there faster, get there quicker, and it may not work out, but if you do, it turns out to be a big payoff. I think that's always out there, and every cycle that is out there. And so I think that's where I think some of the arcs that I talked about, the arc of the partnership, the arc of development, the arc of the rewards, including the balance sheet, the arc of the reward system, which isn't just eat what you kill. Sometimes that is something you need to be patient about. I think our economics are very long dated. My wife was very upset when I told her that we're going to put every dollar back into investing and we're not going to buy a house. We're not going to put a down payment on it. She won that eventually, but we're trying to be investment rich for the long term in our reward system. And I think that leads to a desire for our system to really reward patience and continuity. Look, by the way, it's interesting to see that in 2024 because some of those very people who wanted to see that attractive time give them quick rewards are now coming back to us. It's funny. We actually assembled a statistic. We have had 48 leaders of our businesses who have come from a different part of the firm or have come back to the firm. And 20% of them have come back to the firm to lead businesses after they've left. So the nature of how we've created career opportunities here, I think, is pretty distinct.
How do you think about the impact on culture of bringing someone back who left in an instance to chase a faster payoff?
I have no problem with that. Every person who have left who I've thought was very talented, I've said, you always have a place to come back to, honestly. It's funny. One of my favorite stories was Adam Koppel, who leads our life sciences business, who I'd worked with for 15 years, public investor. He was an oncologist. He was an MBA, great investor in a public market, but he loved private markets. And he's like, I want to do a life sciences fund. And we just come out of the GFC. I said, we can't do a fund right now. We need to focus. And so he decided he wanted to go try to become the CEO of Biogen. And I said, Adam, you're going to be back here in 3 or 4 years. And lo and behold, after a couple of years, being in the corporate world was not as attractive to him as coming back and founding the fund.
So you've stayed private all along. As you mentioned, a bunch of your peers have gone public. What have you seen as some of the internal debate about whether or not to take Bain Capital public?
So we have to debate whether our premise around how we think about those issues is correct. For instance, the ability to start new businesses. I've heard that as something that is enabled by being public. Retaining and attracting people. I think brand as it relates to capital raising. Balance sheet as it relates to having capital to do things more flexibly. All these things have been elements of what I've heard, at least, are reasons to go public. I think as an irony to all that, I think our ability to have a balance sheet, I think, is far more attractive because we've raised it an incredibly low cost capital long term, whereas I think equities are very volatile, so the cost of capital is not always there when you need it. I think that in terms of attracting and retaining people, I think people who come to a firm where we have 100% of our economics to invest in our people and our partnership versus having 50% of it gone forever, I think that's fundamentally more attractive. Starting businesses, we've started 8 new businesses since 2015. And it's all with our people. And I think the opportunity to do that, not by having a brand and capital, but by having people who have decided they really wanted to really pursue an opportunity here at the firm, I think that's a huge advantage for us. I look at all these sort of things that are intended to be advantages. And yet today, I don't think they've in any way precluded our ability to grow and expand and really attract people. And so I think that so far has persisted. I look at the analog of a lot of the private partnerships that used to be on Wall Street that didn't require a lot of capital or being a bank. And I think that analog of being a high-performing, really exciting partnership that has stewardship over time is one that we think exists in the alternative asset industry.
How would you describe the resulting culture from all of those decisions over the years?
First of all, you have to develop a lot of trust-based relationships with people that you're going to be in this partnership with for a very long time. Some of my closest personal friends and mentors and mentees are people who I've lived with for decades. And the culture of that, almost like a big family office in a sense. Even our alumni, we had our 40th in March and we brought back 40 of our alumni partners, people I've known for decades. And just the relationships that have existed for that group for that long, I think it's pretty unique. And I think that exists in the active people today. I think people really understand that collaboration is the core to Bain Capital's distinctive advantage. And when we get together as a vertical, or if we get together as a capital markets team, or we get together in a business unit across geographies, I think just the energy that comes from that teamwork, I think, is definitely different than I think most other firms.
As you look at some of the leaders of the firm that have started younger and worked their way up and been working alongside you for a long time, what are some of the characteristics of the people that have been incredibly successful inside of Bain Capital?
When you're trying to develop a track record of success, taking on the internal assignment or jumping on a plane to go visit a geography because you have domain expertise, but you're not actually perhaps paid in that carry pool, all of these elements that I see becoming dysfunctional in other large global complex firms, we don't see that in our most successful long-term partners. They jump on a plane. They understand it's paying it forward to get paid back. And they understand that's part of our culture. And I think that ethos is a big one. I think the second one is that you cannot be successful at the firm unless you have terrific upward feedback and are able to manage a team. And we measure that every deal. We recognize that as a core principle of one's success is ability to manage a team and get terrific feedback. And I think we also see people who are committed to that development over time and have people who have worked in their lanes that become superstars. A lot of times people, they just aren't trying to develop the next set of generation. They're just trying to work transactionally. And I think that doesn't work in our culture.
So alongside that need to be able to work collaboratively, run a team, how would you describe the investment DNA of Bain Capital?
Because our model is so driven by the performance revenues of co-investment and carry and the balance sheet, and because the only way, at least in our view, one generates that set of outcomes that really delivers the promise of those returns is you got to have an impact. You have to do something different with the business. And so the first question we always ask ourselves is, who are we and why are we here? Why are we going to be able to buy a business, oftentimes at the highest price, and yet deliver a better return than anybody else that's looking at it? And the only reason you can do that is to create some form of inflection, some form of strategic repositioning, some form of asymmetric upside in the operating outcomes, some M&A. And so everything we do is to say, okay, we're going to buy a business based on what was presented by the seller. But if we decide that what they presented is what we underwrote, we're probably not going to win the bid. It has to be some other impact or repositioning that gets us to that outcome. And then the only way it makes it work is if we actually deliver on that through the muscle of our own team. What's the DNA? We're trying to find asymmetric upside, 15 to 20 shots on goal, where we can not just generate a good return. And it may not be 25 times like it was in the beginning. It may not be 10 times like it was 20 years ago, but it can be 3 to 5 and sometimes 10, by the way. But that idea of slugging percentage, of not just being a firm that accepts a modest to good return, but actually a good to exceptional return, and then trying to do that as high as number of times you can in a fund. That's the DNA. We talk about commitment to lasting impact as our purpose, but a lot of that has to do with the idea of just making that inflection and building that greater business and getting the outcome of the return that results from that.
As you look back over the years, somewhere along the way, you run into some challenging times. As you look back, what were some of those most challenging times and the most important things that happened for the firm to get through it?
I think the GFC is really an important one because we were all riding a very attractive tailwind. We were also riding a very attractive development in our business model. There was like the top 6 firms and they all grew very fast and they all had different strategies, although a lot of people thought we were the same. But at the same time, we all were very active from 2005 to 2007. And that was, as they called it, the golden age of buyouts, which turned out to be anything but. And we did a lot of reflection at the time because we thought we could power through with our own operating capabilities to drive outcomes independent of the macro environment that could ever be considered. And so we looked at cycles in the past and we thought we could live through cycles. We would operate through them and still great returns. But the GFC was a bit different. That was the biblical recession that none of us had ever seen before. And so for us, I think we learned a lot in the sense that macro and cycles are to be things that you can be humbled by very quickly. And to scale into that, many of us invested very quickly in the 05 to 07 period. And we all basically correlated to the same return. And out of that came I think a lot of soul searching for firms about how are they going to create even more value? Or are they going to scale? How are they going to scale? What are you going to invest behind to create your own alpha? And then for us, I think it really reinforced the view that we don't want to just be the biggest. We certainly don't want to be concentrated in a couple of years. We have to be much more focused on sort of the macro elements of what can drive outcomes in investment decisions. But fundamentally, we also understood that we had some pretty darn good operating capabilities. So we bought almost all cyclical businesses in 06 and 07. And part of the reason we did that was because we thought that was the only way to get a good value, because we could live through a cycle, buy something that people wouldn't want to buy in 06 and 07, and then come out the other side and time value of money of cash flows, but the exit would be still really good. We were completely wrong, at least in the first couple of years. But the good news is we operated, we had 250 people. 2/3 of those people were working inside the companies, and we call it getting across the icy river. We got across the icy river, which was probably, in some ways, we'll never get rewarded for it, but it was probably one of our finest moments because we took a fund that was marked down to 0.65 and ultimately made over 2 times our money on that fund, and with all cyclical businesses. So we learned a lot, but we also made the right strategic choices about how we wanted to grow from there.
As you look back, what are some of the biggest challenges you feel you've successfully overcome as a business?
Partnership has a double-edged sword. Partnership implies collaboration. Partnership implies consensus. Consensus can be a terrific thing to vet outcomes and get to a better answer. Sometimes consensus can yield to lowest common denominator and perhaps less nimble decision-making. And so when we got to a size around the GFC time period, working too much in collaboration, committee structures, and consensus-driven leadership committees, I think those things were recognized as not healthy for the business. And so a lot of what we did coming out of the GFC is to create more alignment around sets of accountabilities among individuals or maybe a couple individuals, and empowerment as well of certain individuals to drive more decision-making, more accountability for a more nimble partnership. And that wasn't easy. We started out as 18 after Mitt, or 18 or 20, and we had that governance model I described. But then over time, we're 180. We have $200 billion of assets. We have 13 strategies. The ability to empower people inside that structure was an important step in having not a committee running the firm, but a couple co-managing partners, having somebody run private equity as opposed to a committee. All these things that sometimes have that set of trade-offs. I think we did a lot of work to overcome, and it's been terrific. And it's actually created a flatter structure in some ways because people feel more empowered. It's not hierarchical. It's actually giving people real responsibility.
How have you thought about the increase in competition over the years? In the early years, the Bain Capital model, that consulting-driven operational improvement, may have been one of the few important players doing it. And now you have a lot of everything.
First of all, I do laugh a little bit because there is this check-the-box strategy now for if you're in private equity, which is you have to be strong in your vertical, you have to be global, you have to have value creation, you have to specialists. I think there's a difference between having those things and being able to operate those things successfully. And I think that the one thing, again, it comes back to the culture that we've done really well is integrating those elements of the business. So yes, it's gotten a lot more professional at value creation and all the different specialists in talent and IT, go to market. All these things have gotten way more sophisticated, and verticals are far more deep than they've ever been in terms of what you need to know about a sub-vertical, let alone a vertical. And being deep in a geography, 100 people in Japan, these are all things that are table stakes to be really successful, is that depth that I'm describing. But then how do you bring it together? If you're doing an industrial deal, our ability to take 40 years of experience doing industrial deals, 40 years of value creation efforts, and getting better and better at them every year in our value creation capabilities, and then having that team that does the delivery of outcomes partner with the people that are underwriting the deal, and even the portfolio team being part of the underwriting team, that integration is core to what I think makes us different. It is not a bunch of silos where people have their own roles. We're one team with different types of capabilities that get integrated. In the beginning, it was one person. The person did the deal, they underwrote it, sometimes they went in to manage it, but now we're trying to recreate that synthesis through deep capabilities, but then integrating it into a team that actually operates in a very different way than our peer set that might just use an in-house consulting firm. And then on top of that, every year we have some form of offsite where we talk about the next 5 ways we're going to get better. So this notion of continuous improvement and just not sitting still, it's got to be a core to somebody being successful in our industry. And we actually have invested in over 500 companies. And so that accumulated experience makes a difference.
So you had your first, let's call it, event of succession 25 years ago when Mitt left. And now you and your partners that have been around the firm for 25, 30 years, over the next, let's just say 25 or 30 years, will probably be moving on as well. How have you thought about continuing to perpetuate the strength that you've had at Bain Capital into another generation of leaders?
I think you're right in saying it really started with the Mitt succession, but I think we've had it in a lot of places, whether it be in Asia when Paul Edgerly left and we had to create succession in Asia, or whether it be Dwight Poehler in Europe or Steve Barnes in North America. So we've had this continuous process of trying to both identify people who have that interest and train them and develop them to be not just investors or portfolio team members, but also try to be leaders. And we don't do it in a disruptive way. I think they earn it through being empowered as taking on roles as part of being either part of people leadership or the investment committee, or they end up taking on some form of leadership in addition to their investment or impact role. And over time, I think we've had this premise that you need to add value in the investment business, but also be able to make an impact internally through leadership. And so I think that's been the secret of how you identify those folks. The challenge, of course, is that people love to do investments. They love to make an impact. And so you need to create a structure that gives them the ability to do both, but not distract them from doing deals. Even I, who have probably had the most internal responsibilities over the last 10 years, I still highly engaged in our investment committee process. When I first took on the role of global head of private equity, I was spending 75% of mine doing deals. We are an industry of practitioners who also need to take leadership roles. And I think that type of credibility of having people who have been doing deals, making an impact in companies, and then putting them in leadership, that's been part of how we've grown our firm and created great leadership.
How much of that selection of leadership is nature versus nurture?
There are incredibly successful deal makers and portfolio folks who would not be great leaders or don't want to be. And so I think that's a common mistake that firms make, is they put their best deal makers who don't either have the interest or capability as leaders, and that becomes a problem. So it does require both. You have to have people who can have the interest, but also the capabilities to do both.
As you look out over the next 5, 10, or 40 years of Bain Capital, what do you see as where the business and the industry heads?
Won't surprise you, I'm a big believer in private capital. I think unlike some others who think private equity has begun to mature, I don't have that view. I start off with the very fundamental premise of the principal orientation of having aligned interest in creating equity upside through governance, long-term orientation, and ultimately today, big transformational operating change. There's no shortage of need for that in lots of forms of corporate conglomerates. A lot of what gets done in those are highly inefficient, ineffective. In a way, the private equity is just the opposite, very effective in what we do. And so I think we're going to get bigger. I think we're going to get even more highly penetrated into the equity markets. I think it's a better model for driving value for equity and investment returns. And so I think we still have a long way to go there. You saw that a little bit in some of the shrinking of the public market during the latter part of the hypercycle of 19 to 21. But I think over time, put aside that's a momentum play, I think you're going to see forms of private capital with a longer term orientation, with skills to manage those businesses in a better way in this private equity model. I think that will persist and grow. And then as it relates to the other parts of the asset space, there's even more opportunity to be more professionally managed in the fragmented real estate industry. Infrastructure is just starting, and there's a lot of value that very sophisticated global players who have capabilities can bring. Certainly in the case of credit, where I think the credit market dislocation coming out of the banking regulation and the GFC, I think has created a real understanding that the private credit platforms are really the part of the future, as opposed to something that people would say today is just come along and is cyclical. I do think that's a secular trend.
What do you think will define the winners and losers in that landscape?
It's 100% people. Look, I do think the alt asset space, there's a long time between when the active management public space went from being a really people-driven business to becoming a more distribution business and more commoditized. I think in the same way, but way earlier and way, way harder, the private space is definitely about the talented people that you can attract and retain. And so from our standpoint, that's where the prize of how you structure yourself, how you create a culture, and how do you make it exciting for people to want to come to work in this industry, which, by the way, creates a bigger pool of people coming into the industry than I think would have come in 20 years ago. And so all those elements, I think, still are critically important.
As you look back, what do you see as some of the greatest successes and greatest challenges you've had over this time at Bain Capital?
When people go back and think about the ability for the world and the U.S. economies in certain countries to become even more fundamentally more productive, fundamentally more successful, I think the role of having principle-oriented private capital be at the table to drive outcomes, I think that's a great story. And I think the fact that it started out as barbarians at the gate in financial engineering is such a misplaced metaphor for what we do that I think I really do look back at our industry, not just us, and just say, wow, this is a pretty cool thing. That doesn't happen in the public markets. I think the other piece is just, I think the people and careers and the ability to drive some of the career opportunities, but also the career development of people I've worked with is a very much a success. And I suspect that if you talk to Mitt Romney or Josh Bekenstein or Paul Edgerly or Mark Donnelly or Steve Pagliuca, Steve Barnes, or all these people that are my mentors, they would say the same thing, is the people. I think the failures, look, we're 40 years in, the narrative for our industry is still pretty negative. It's not that far away from the barbarians at the gate stereotype that we've been living with from the start. And so I think that we need to turn that around. And I think there's hopefully a way to do that since we're now more in the mainstream. And I think shedding light and transparency, I think will set us free, because I think the good things we're doing is amazing as an industry. And I think the great things that we're doing relative to building businesses is something that should be part of the success, not the failure of where the narrative is.
What do you see as some of the most important takeaways you have from this journey for you?
One of the most important ones is that this principle of how to drive an outcome by building a business or changing a business or building a management team or developing careers, all these things they're transformative. They're things that you're taking something and you're changing into something else, is just a really cool thing to be involved with as a person or as a firm or with a set of people who you might attract to the firm. And so what I love about, I used to call this business summer camp when I first got here, because you get to work on a little strategy, a little operating efficiency, work on the board level, work with management teams, due diligence. And so that business summer camp metaphor, if you will, is a great playground to then say, what are you going to do with that? What are you going to do with those sets of activities? And I think the ability to do those activities in a way to build an enterprise and to build companies, that's a really interesting career choice, a way to attract people, and then a way to create a great firm. The hallway chatter of this summer camp is actually pretty much the same, and that people really get jazzed about making that impact. And I think that's a key takeaway. Is it the same in the rest of the industry? I think it is. I think people really believe that they're helping businesses and building better industries. And my excitement for the industry, therefore, is pretty high.
As you've looked back and celebrating 40 years of Bain Capital, how have you thought about what the legacy is of this business?
The ability to have entered this business, grown this business, and then ultimately create a very different model for a large-scale player is a pretty interesting legacy for the founders and for all those that help build this business, because our ability to be a partnership at scale, our ability to be the largest investor in our funds, our ability to generate consistent, differentiated 1,000 basis points of premium over our public equity return reference points, our ability to keep people for 25, 30, 35 years, our ability to make an impact in communities through the terrific ability to work with our companies, work with our teams and all the 23 offices we have. All these things are focused on making an impact and in different ways. So that legacy was a pretty interesting one versus stereotype of our industry, which is about a bunch of financial engineers just gathering assets. That's not something that's interesting to us at all.
Well, JC, I want to thank you so much for sharing this incredible story of 40 years of success at Bain Capital.
Hopefully, we'll look forward to the 80th celebration 40 years from now.
Thanks for listening to the show. To learn more, hop on our website at capitalallocators.com, where you can join our mailing list, access past shows, learn about our gatherings, and sign up for premium content, including podcast transcripts, my investment portfolio, and a lot more. Have a good one, and see you next time.